Good evening. Thank you very much. I'm going to give a kind of totally different perspective on this. I'm here as an investment banker, and what that means is that I work with gold companies along with many other companies dealing in a variety of other metals and mining and steel and related industries. And I deal around the world. So my practice is not confined to the United States. It's a global practice. And frankly, most of the activity in the mining sector today takes place outside the United States and outside even North America, Australia, Africa, Russia, Asia. These are all huge areas for mining and mining involvement. Gold is just one of the metals that I deal in. I'm not a broker-dealer. I don't sell gold. I don't advocate gold as an investment. I have nothing to do with investment. So if I'm not here to discuss with you gold as an investment or gold as currency. In fact, from an investment banking perspective, gold is an enigma. Why is it an enigma? Because almost every other metal, in fact, every other metal that I can think of, is valued on an industrial basis. There's supply and demand, there's usage, there's industrial usage around the world, and that's, in essence, how valuations of metals take place. Gold is not like that. Gold I call an emotional metal from an investment perspective, because as people feel good or feel bad, the value of gold as investing opportunity goes up or down. Very different from every other metal that I'm involved in. So with that as a background, let me just take you through a few slides here. Okay, point this thing. My guys picked out a very nice little cover here. I like that one. Okay, so gold, obviously, from a currency, from an investment perspective, we all think of gold as a safe haven. We all know about how gold has gone up in price. That's just kind of background material. The sources of gold, where do we get gold from? Well, we get it from mining, we get it from recycling, we get it from sales from central banks. Where does the demand come from? Now, this is the interesting part. Demand for gold primarily comes from the jewelry industry. I don't know if you're all aware of that, but that's the primary area where demand for gold comes. And the number one country where demand for gold for jewelry comes from is India. Because India has a portion of the year when young people get married and the dowries always contain gold, and gold is focused from an industrial perspective on that portion of the year. So, as I said, as opposed to other metals that have industrial uses, like coal, manganese, iron ore, etc., gold gives a different perspective here. Demand in gold has increased tremendously. First quarter of 2011, it's up 11% year on year. At the same time, gold supply has diminished by 4%. That obviously has an effect on the value of gold, again, irrespective of industrial usage. So this chart we can kind of skip. I think you've heard these things. Gold's primary value is as a fiat currency hedge. I think you've heard from other speakers about its value as a currency. As I said to you before, it's an emotional metal. It trades from an investment banking standpoint, not on the basis of inherent value, but on perceived value based upon people's perception of the economy. Very different when we talk about gold stocks, which I'm going to get to in a minute. Gold stocks trade like every other stock is concerned. And you'll see that actually gold stocks have underperformed the market for gold as a separate entity. The risks involved in the gold as an investment side of things include physical risk, political risk. There are various countries that gold is mined that have all kinds of political consequences to them. There are market risks, there are exchange rate risks, and of course technological risk as gold goes up and down in terms of its ability to be taken out of the ground. From a stock market perspective, again, looking at gold companies, this is probably the key chart that I'm going to show you. If you see the cost per ounce, which is the way that gold companies look at what they have. How much does it cost to get an ounce of gold out of the ground? How does that compare to the history? And what does that do to the margins of these companies? As you can see from the charts here, the cost of extracting gold out of the ground has risen dramatically. That's in part because of the fact that there's a lot more companies that are now trying to get gold out of the ground as gold goes up in price. Remember, the marginal companies get into an area as the pricing goes up. The bigger companies increase their capacity, the marginal companies jump in, various equipment is then used and becomes in short supply. So at the end of the day, it costs more to extract gold from the ground. That in turn affects the profitability of gold companies. So if you're looking for gold companies to invest in, I would tell you that the key metric is going to be the cost per ounce. Look for that. Those companies that are in jurisdictions where there's low cost, or if they're in a position where for historical reasons or otherwise they've got lower cost per ounce, they're going to be the most profitable companies. They're going to be more valuable from an investment perspective. And the reciprocal, of course, is apparent, and that is higher costs, lower margins, lower profitability, and therefore probably not going to be as good an investment for you.
I'd like to interrupt with a clarification question. On this chart, I noticed the scale is inverted. You move time to the left.
Yep.
Is that correct? And could you just interpret 2 points so everybody can understand? Let's take 2011 for senior gold companies. What does the green bar tell you, and what does the yellow bar tell you, the yellow line?
The yellow line just tells you that there's very little margin left when you have a $538 cash cost. That's what it's attempting to tell you. And the other side of the chart, the mid-tier companies, is showing you that for the most part, the mid-tier companies, because they're jumping into the marketplace and they're not as mature and they don't have the same kind of infrastructure, their costs are even higher. And therefore, to a certain extent, their margins are even more difficult. But you'll see later on, from a stock market perspective, the mid-tier companies have returned more than the bigger companies because there's more upside opportunity that's perceived with those companies. Okay, next chart just talks about M&A activity. Like in any other sector of the economy, there's always mergers and acquisitions, and the gold sector is rife with mergers and acquisitions. The big companies try and get bigger, the small companies get ready to sell out, developmental stage companies and exploration stage companies look to get bought by bigger companies. It's the minnows getting swallowed by the whales, as you have in many other industries. And the activity level, of course, during the financial crisis dropped to almost zero. But at this point, the level has picked up. It's another way that you can make money as an investor in gold if you can pick the right companies that are ripe for consolidation with the bigger companies. This next chart is what I was saying before, that the prices for gold miners in general have not kept up with the pace of gold as a separate investment, because gold companies are measured by a different standard from an investment perspective than gold is measured in and of itself. I don't know, to be honest with you. Okay, next slide gives you an idea of producing countries and how this has changed. Back in 2005, South Africa was your #1 producer of gold. Australia was #2. U.S. was #3. Look to the left-hand side, and you'll see that in 2011, China is now the biggest producer of gold. Australia is second, U.S. is third. South Africa has dropped down to fourth. Again, it's just a matter of the amount of intensity and operations that are brought to bear. Gold is found all around the world. It's not as if gold is found in only one place within the world. So there are many, many jurisdictions in which gold can be mined. And whether or not the political climate is hospitable towards gold companies, whether or not the government is stable, these are all factors that enter in. There are gold companies that some of you might own that are operating, for example, in Western Africa, in some of the most unstable political areas that you could possibly imagine. But they believe that they still have arrangements which they think they can rely upon with the government in order to extract gold at a certain price, and therefore they continue to operate in these places. I happen to think that political risk is a big, big issue in all of the mining areas. Mining, in a sense, is a very simple concept. It's all about connecting the dots between where a deposit is located and being able to get that ore out of the ground to a port for export at a commercially reasonable price. It sounds simple, but it's not so simple, because it involves not only mining, but it involves whether there's infrastructure in the country, things like power, rail, roads. You'd be surprised how many places where gold is mined and other metals are mined do not have basic infrastructure. So that has to be taken into account by companies that are operating in those areas. Will they have to put in the infrastructure? Do they have stable governments that they can deal with? Can they rely upon the deals that they have with these governments? And every once in a while, in fact, not infrequently in the industry, we hear about companies that have one project or another blow up because all of a sudden the government decides that, all right, now we want to participate in the profits of all the mining companies that are in our jurisdiction. Or we want to change the rules, or the next coup takes place and somebody else comes in. So mining companies have to deal with these ups and downs all the time. As investors, you don't really see that unless you go beneath the surface. But from a mining company perspective, from an investment banking perspective, we look at things like that. Okay, last chart that I have here is kind of a detailed summary. I don't know if there's a way to give you a copy of this or not, but the interesting thing is if you take a look at the column here, I'm not sure how I get the pointer to work on this thing, but anyway, in the middle? I see, okay. So this is a 5-year total return column right over here. Just look at that as a kind of point of reference. It shows the senior gold companies on the top portion of the chart. You know, companies like Barrick Gold, Goldcorp, Newcrest, etc. And the actual returns that these companies have given over 5 years, which is a pretty good period of time to reflect upon, are relatively modest in comparison to some of the mid-tier companies that you see on the bottom over here. And again, that's a function of the fact that mid-tier companies are ramping up. People tend to invest in those companies because they see growth opportunities that they don't see in the bigger companies, and also because of M&A activity. If a company gets from an exploration and development stage up to the point where they're ready to be acquired by one of the major producers, that can be a big capital-producing event and therefore a value-producing event for shareholders. So anyway, to kind of summarize my position here, from an investing standpoint, I take no position on gold itself. I can't tell you whether gold is going to trade at $1,500 or $2,000 or $10,000 or $50. That's not relevant to me. But from my perspective, what I look for are companies that have assets that are good assets in stable jurisdictions where there is infrastructure, where they can produce gold at a cost per ounce that's a reasonable cost in relationship not only to the rest of the world, but in relationship to their expenses, where they can produce a decent margin which can then be capitalized from a market perspective, and where one can see a decent rate of return. There are some fine major gold companies, and there are some fine mid-tier companies that are out there. Gold is going to be around as an investment vehicle apart from its from simply its status as a metal. It's going to be around as an investment vehicle forever. It's been around forever, and I wish you good luck in your investing. Thank you.